Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. And welcome to part 2 of the mini-series on superannuation. If you haven't seen part 1, make sure to check it out. We're talking about the purpose of super and staple funds. And we also went into how much it costs the government to offer the tax concessional environment, and how much the largest super fund has. For those that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FASEA compliant, where we specialized in super and non-super investments. Now, unfortunately, I'm not licensed anymore, but I would love to get my license back one day. I left the industry as I could not stand the owner of the business, and I've got no interest in sales. I mean, it's not all sales, but my passion is to help people, not to sell various managed funds or insurance products. These days, I work with tax. Now, today we're looking at contributions and super guarantee. Let's start off with what is a contribution. Now, this is elaborated in TR 2010-1, and it basically says that any transfer to the fund. I'll link below the TR as there's more, but includes cash, electronic transfers, and promissory notes. Now, Division 290 to 293 of the Income Tax Assessment Act 97 discusses different types of contributions that can be received by the fund. Division 295 talks about what is considered to be income of the funds, and Division 301 to 307 goes through the benefit payments and the tax treatments of that. There are a range of different requirements as to when you can make a contribution, how much that contribution can be, and also the tax treatment of that contribution. It's a very convoluted system, and it's really tough to navigate. I guess that's why I'm making this series, to help people understand super better. The basic contribution requirement for your super fund to receive SG is that you need to be working. All super funds will accept SG for you no matter what your age is. However, if you're not working, you aren't earning SG. For concessional contributions, you need to be age 74 or younger. There are catch-up contributions which have different requirements, and I'm going to talk about that on the next episode. For non-concessional contributions, there was both an age requirement and a balance requirement. This is also something I'll look into further on the next video. When it comes to contributions, let's start off with superannuation guarantee, or SG. SG is a mandatory contribution to super made by your employer. If you are earning a salary of, say, $100,000 plus super, then you'll be getting super guarantee of 11.5% on that salary. It will actually be 12% from 1 July 25, and that gets paid directly to your super fund, so you never actually receive those dollars in your hand. This type of contribution is taxed at a concessional rate compared to if you had received that personally. When it gets added to your account, the super fund will pay tax on that contribution at a rate of 15%. If you were to receive that amount personally, that 12K will get taxed at your marginal tax rate, which in the example I'm using would be in the 30% tax bracket, and so you're saving 15% tax by having to go into super instead of personally, plus 2% since you don't pay a Medicare levy on it either, so really it's a 17% tax saving. Before I go into contribution limits, I need to make a few additional comments directly relating to SG. So contributions made by the employer, currently they need to be paid at a minimum of quarterly. They can pay it more frequently, but the government has passed legislation for payday super, being that the employer needs to pay your super when they do your payroll. That's not coming in until 2026. In the meantime, employers have until 28 days after the end of the quarter to pay your super. So for the January to March quarter, you might not be paid until the 28th of April. Obviously, they can pay it earlier, but that's the latest they are allowed to pay your super. Important thing to note in relation to this is that when it comes to the timing, that it's not counted from when your employer pays. It's counted from when the super fund receives it. If the employer pays on the 20th of April, but the super fund doesn't receive until the 1st of May, it's late. With the caveat being that the ATO super clearinghouse, if they use a private clearinghouse, the timing is when the super fund receives the contribution. If they use the ATO clearinghouse, it's when the ATO receives the money that counts for timing. If they don't pay on time, there's something called the SG charge. And this is a penalty placed by the ATO on the employer for failing to pay your super on time. This is charged at a rate of 10% and is not a deductible expense, which is what matters to employers. I found employers are happy to flaunt the rules, not pay their tax on time, and then when they get the SIC, or shortfall interest charge, or GIC, general interest charge, these are tax deductible, so they don't care too much. With the SG charge being non-deductible, they're a lot more likely to pay on time. So who is entitled to SG? almost everyone, but not everyone. Up until recently, if you earned under $450 in a month, the employer was not required to pay you SG. This has thankfully been changed, and there's no longer a lower monetary barrier to earning SG. There is an age barrier, however. If you're under the age of 18, employers are not required to pay SG unless you work more than 30 hours in a week, which means unless they've left school and are working full time, it's unrealistic. So essentially, no 18-year-old is earning super. One thing to note with this is requirements. So employers are not required to pay super guarantee to under 18s. Doesn't mean they don't. Some will still pay even though they're not legally required to. SG is also not accrued on overtime, only on your ordinary time earnings, or OTE. If you work a salary at say 60 grand and you get 20k of overtime each year, you're not paid super on 80k, just the 60k base. The government has also implemented something called a maximum earnings base for super, and this is around $58,000 to $59,000 per quarter. What this means is if you earn more than this, make sure you check your contract, because employers are not required to pay you SG over the earnings base, which is around $235,000 per year. So SG on 235k is about $27,000. If your contract explicitly says X amount plus super and it doesn't specify a cap, they need to pay you the full amount, and this needs to go to your super. They cannot pay it out to you as wages. If it says Y amount up to the maximum earnings base, then even if that 11.5% should be say $30,000, you're only getting 27 grand paid to your super account. There are also special rules for contractors, and this came out in the SGR 2005-1. Now, SGR being Superannuation Guarantee Ruling, and this says that if you are paid for labor and you have no right to delegate work, i.e. you're basically just paid for your time, either wholly and principally for your labor and not paid for your specific result, then you're considered to be an employee. And if you're considered an employee, then you are entitled to super guarantee. What a lot of dodgy businesses will do is they will ask you to create an ABN, and they will pay you through that. They will say that because you're paid via ABN, you're a contractor, not an employee. And as a contractor, they don't need to pay you SG, which is wrong. This tactic is well known, and it goes by the name of sham contracting arrangements. The other thing to note for SG requirements is that directors could receive SG if they've been paid a wage for their role in the business. Sole traders are not required to pay themselves SG, and this is where they get into trouble, is they work as a sole trader for say 10 years. They don't pay their super, and the business is only slightly profitable. They might end up closing it down with very little to show at the end. It's probably obvious, but dividends do not attract SG. A lot of small business owners will pay themselves both a salary and a dividend. Salary attracts SG, dividend does not. Division 291 and 292 talk about the contribution caps, and there need to be caps on how much money goes into super. Because someone that's very wealthy and can afford to forego income shouldn't be getting a bigger tax break than the average Australian. Currently, the contribution cap for a concessional contribution, that is the type of contribution that you don't pay tax on personally, and I guess the concessional tax treatment of 15% tax, is $30,000 per year. Now, there are 5 types of contributions that get treated as concessional contributions. The first one, which I already mentioned, is your super guarantee from the employer, and this is a mandated contribution. If they're generous, which 99.99999% of employers are not, they might also decide to pay you more than the minimum. This is called a voluntary employer contribution. Basically, this means anything over the minimum SG rate. Next, we have salary sacrifice, and this is where you ask your employer to add an additional amount of super. This gets taken from your pre-tax salary and gets paid directly to your super account. We have personal concessional contributions. This is where you get paid an amount and you pay tax on it personally. You then contribute to your fund post-tax, but you lodge an NOI, a notice of intent to claim a tax deduction form with the super fund. They will then take out that 15% tax, and then when you lodge your taxes at the end of the financial year, you get a tax deduction on that amount you put in. The final one, which you might not actually consider contribution, is employer-funded insurance. Now, this might sound wrong, But if you're not paying for it, it's considered extra income or an extra benefit provided by the employer. If the insurance is $100, then it's $100 less of the cap that you can use. If it's 10K, then it's 10K less available for you to use. So this is something important to bear in mind when you're thinking about contributing more to your super. All of these contributions are treated equally in the eyes of the ATO and super law, and they're all included in the cap of $30,000 a year. If you exceed the cap, the super fund will need to take extra tax to turn it into a non-concessional contribution, and it will be taxed at your marginal rate. There are other rules around carry forward contributions that I'll go into in the next session, but for now, just know that the cap of concessional contributions is 30 grand a year. While concessional contributions normally get taxed at 15%, there is one exception, and that's Division 293. Division 293 is an additional 15%, so a total of 30% tax for high income earners. By high income earners, we're talking people that make over $250,000 a year inclusive of super. To be earning that much, you're in the top 5% of earners. So, I don't know about you, but I don't really feel too sorry for people earning that much income, for them to pay a little bit more tax and to even the playing field a little bit. When it comes to non-concessional contributions, there are different higher limits to what you can put into super. The non-concessional contribution cap, NCC cap, is set at 4 times the CC, concessional contribution cap, which is currently 30K. So NCC is 30 times 4, being 120. The reason this is higher than the concessional cap is because this is post-tax money. The government is happy for you to put money into super post-tax because they've already received a decent chunk from you. But to get the low tax rate, they don't want to give it away too much. I'm not going to talk too much here today about NCCs. That's what we'll dive into more in the next episode. But before I finish this episode, I need to talk about why people love super. And it's not just because of the tax deduction they get for contributing up front. It's the ongoing lower rate of tax that super receives. Division 295 talks about the tax rate of the fund income, and Division 301 to 307 talks about benefit payments. There's 2 types of fund income to consider, and they each have different tax rates. Think income and capital gains. Income from interest or dividends or rent is treated the same within super as contributions. This means that any income of the fund generates will be taxed at 15%. If you were to own the same investment outside of super, you'll retain tax on this income at your marginal tax rate. So not only is it beneficial from an initial tax saving perspective, you also get long-term tax savings. Capital gains are slightly different when held through super versus when held personally. When you own an asset and sell for profit that you own personally, if you held it for more than 12 months, you get a 50% discount on the gains. So you'd only get half added to your taxable income. When this asset is held within super, you get a 1/3 discount. This means instead of paying tax on the gains at 15%, you pay tax at 10% for long-term gains. So if you make $100,000 in long-term gains, you only pay tax of $10,000. Pension assets and income from drawing a pension is fully tax-free. I'll get into more detail about this later. We've got 3 episodes specifically on pensions. The final thing I want to mention is a change the government has made in regards to the taxable income of a super fund that only affects large balances. Currently, it doesn't matter how large your super balance is, you pay a maximum tax of 15%. What the government is implementing is for balances over about $3 million, which is currently very few. But over time, as they have said it will not be indexed, a lot more people will be affected, is that tax will be increased to 30% for the amount over $3 million. It's not 100% clear how they will enforce it, but it sounds like they will tax unrealized gains. So if your balance goes from $3 million to 3.1, they will tax that $100,000 gain at 30%, even though you haven't sold anything or generated an income on that amount. Time will tell how successful that is, as it's not coming in until 2026, so we have a little bit more time to work out the kinks. Hopefully I've been able to help you better understand SG, concessional contributions, and non-concessional contributions. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you guys in the next one.